Seeing tax deducted every month can create a false sense of closure. The payslip shows that something was withheld. The employee assumes tax is handled. The employer has payroll. Money was deducted, so the story must be complete. But monthly withholding is not always the full-year tax position. For foreign nationals in China, individual income tax can depend on residence days, income type, benefits, allowances, bonuses, overseas income, annual settlement, and supporting records. This episode is not a tax tutorial. It is a warning about record and timing. The first hard anchor is the 183-day rule. Residence days can affect tax resident analysis. A person who spends substantial time in China may face a different tax position from someone who is only present briefly. The point is not that every person should calculate everything alone. The point is that day count matters, and it should be tracked before the annual review period arrives. The second anchor is the 6-year rule framework. Longer multi-year residence can trigger deeper worldwide income considerations under the relevant framework. This can matter for foreign nationals with overseas income, overseas employment links, stock plans, investment income, or complex compensation. The third anchor is tax rates. Individual income tax rates can range from 3% to 45%, depending on taxable income category and bracket. This range matters because salary changes, bonuses, allowances, and income classification can change the final position. The fourth anchor is annual reconciliation or settlement. For many individual taxpayers, annual reconciliation commonly occurs in the March to June period. This is when the monthly payslip impression may be tested against the full-year picture. The fifth anchor is benefits and allowances. Housing benefits, education support, relocation benefits, bonuses, reimbursements, and employer-paid items may need proper documentation and classification. If records are weak, the tax position may be harder to support later. The sixth anchor is overseas income. Some foreign nationals continue receiving income from outside China, remote work, dividends, equity compensation, consulting income, or home country employer payments. Whether and how this affects China tax depends on facts, residence status, treaties, and professional analysis. The risk is ignoring it until annual settlement or a later review. The seventh anchor is documentation. Tax is a record problem as much as a calculation problem. Contracts, payroll records, pay slips, bank records, benefit policies, invoices, rental documents, school documents, travel records, and overseas income records may all become relevant. Here is how the tax gap appears over a year. A foreign employee works in China and sees tax deducted monthly. Everything feels settled. Then, during the year, several things change. The employee receives a bonus. They spend more days in China than originally expected. They use housing or education benefits. They receive some income connected to overseas work. The employer withholds tax monthly, but no one has organized the supporting records. When annual settlement arrives, the annual picture is different from the monthly payslip impression. The monthly withholding was real. It was just not the whole story. The risk is not only paying too much or too little. The risk is discovering too late that the records needed to explain the position were never organized. The framework to save is tax position check. 1. 183-day logic. Track presence in China because day count can affect tax analysis. 2. Income type. Salary, bonus, benefits, overseas income, and equity can behave differently. 3. Benefits and allowances. Make sure housing, education, relocation, and reimbursements are documented properly. 4. Annual settlement. Do not wait until March to June to discover the full year picture. 5. records, keep payroll, contract, bank, travel, benefit, and overseas income materials organized. The lesson: monthly withholding is one record. It is not always the full tax position. For foreign nationals in China, tax planning is about day count, income structure, annual timing, and evidence. The practical habit is to keep a tax file during the year. Track days in and out of China. Keep employment contracts, payroll slips, bonus notices, benefit policies, rental records, school-related records, reimbursement materials, and overseas income documents where relevant. If a question appears during annual settlement, the records should already exist. Waiting until the settlement window to reconstruct travel days, benefit treatment, or overseas income history can create unnecessary pressure. This is especially important for mobile executives, founders, remote workers, and employees with stock, bonus, or cross-border compensation. Their tax position may not be fully visible from a monthly payslip. There is also a family planning angle. When a foreign worker brings a spouse or children, tax records, salary records, housing benefits, education benefits, and employer support can become part of the broader financial picture. The tax file may not directly decide every family status question, but it can affect budgeting, school planning, payroll credibility, and future review. For founders, the personal tax file connects back to the company file. Founder salary, dividends, reimbursements, overseas income, and business expenses should not be mixed casually. The cleaner the records are during the year, the less pressure there is during settlement. A useful closing question is, if someone reviewed my full-year tax position today, could I explain my days in China, my income sources, my benefits, and my supporting documents? If the answer is no, the issue is not only tax calculation, it is record readiness. And record readiness should be built before the filing season arrives. A spouse or child is not simply added after the main applicant. Their timeline is a parallel track.